You're watching the ticker, waiting for silver to drop just a few more percent before you pull the trigger. That limit order is set, but what if the game you're playing is already over? There's a trap that has nothing to do with the price on your screen. While you're focused on saving pennies in the paper market, the physical silver you're trying to buy is quietly disappearing. This is the silver supply trap. And if you're relying on a limit order, you might be making the most expensive mistake of 2026. That gap between the paper price and the physical reality is what we're breaking down today. Traditional investment strategies built on waiting for pullbacks are failing because they're based on an outdated assumption that the metal will always be there when you're ready to buy. We're going to dissect the paper price illusion, expose the real supply crisis happening right now, and show you why the premiums you pay tell the true story. By the end of this, you'll understand why acquiring physical silver is becoming less about timing the market and more about securing any metal you can before the window closes entirely. So let's start with the number everyone watches, the spot price. This is the price quoted on the COMEX, the New York Metals Exchange. But here's the critical thing. Most people miss that price isn't for a bar of silver. It's for a paper contract, a promise to deliver silver at some future date. This creates a massive illusion. The paper market can be flooded with contracts, driving the price down, even while the actual physical metal sitting in vaults becomes scarcer and more expensive to obtain. Think of it like this. The paper market is the menu price at a restaurant, but the physical market is the actual meal. The menu might say a steak is $30, but if the kitchen runs out of beef, that price is meaningless. The COMEX price is the menu. It can be manipulated by large traders selling contracts they never intend to deliver, creating a false signal of abundance that tricks investors into waiting for a better deal that may never come in the real world. This is why recent examples of alleged paper price manipulation are so significant. We see massive, rapid sell-offs in the futures market that drive headlines about a silver crash. Yet, if you immediately go to a major bullion dealer, the price you pay has barely budged. The spot price drops 5%, but the premium, the extra cost over spot to actually get the metal, jumps 10%. The net effect? The real cost to you, the buyer, went up during a supposed price collapse. That's the first clue that the system is broken. The paper price is becoming increasingly disconnected from the logistical and physical reality of sourcing, minting, and delivering real silver. It's a derivative of a derivative, a signal that's losing its connection to the source. So if the paper price is a misleading signal, what's actually happening on the ground? The physical supply chain for silver is facing a perfect storm. Let's start with mining. Global silver production has been essentially flat for years, struggling to hit new peaks. We're not discovering massive new silver deposits, and the ones we have are becoming more expensive to operate. Many mines are polymetallic, meaning silver is a byproduct of mining for copper, zinc, or lead. If the economics for those primary metals weaken, silver output falls regardless of its own price. We've been in a structural supply deficit for years, where annual demand consistently outstrips what mines and recycling can provide. That deficit is simply being filled by drawing down above-ground stocks. And those stocks are not infinite. Then you have industrial demand, which is the silent giant in this story. Over half of all silver demand is industrial. It's in every smartphone, every solar panel, every electric vehicle. The green energy transition is incredibly silver-intensive. A single solar panel can contain around 20 grams of silver. As countries ramp up their solar capacity, that demand is not a speculative bet. It's a locked-in physical requirement. This industrial demand is what's quietly consuming the available supply. It doesn't care about the COMEX price. These companies need the physical metal to build their products. They're buying it directly, taking it off the market permanently, and turning it into components that will never be melted down into a bar again. This brings us to recycling, which people often point to as a solution. But recycling has severe limitations. You can't efficiently recycle the tiny amounts of silver dispersed across millions of electronic devices. The economics are challenging, and much of the new industrial use, like the silver paste in solar panels, is effectively lost for decades. So recycling can only ever fill a fraction of the gap. Finally, consider the geographic concentration of risk. A huge portion of silver mining and refining is concentrated in just a few countries, primarily in Latin America and China. Political instability, labor disputes, or changes in export. Policy in any one of these regions can instantly choke off a significant portion of the global supply. This isn't a theoretical risk. We've seen it happen. When you combine stagnant mining, soaring industrial demand, limited recycling, and geopolitical supply chain risks, you have a recipe for a physical crunch that the paper market is completely ignoring. This brings us to the most important number for a physical buyer, the premium. The premium is the difference between the paper's spot price and what you actually pay a dealer for a coin or a bar. This isn't a fee. It's a real-time market signal. It represents the actual cost of fabrication, distribution, dealer margin, and most importantly, the scarcity value of the physical product itself. When premiums are high and rising, it means the physical market is tight, regardless of what the COMEX ticker says. Look at the case studies, American Silver Eagles or Canadian Maple Leafs. During periods of high demand, the premium over spot for these coins can double or triple. The spot price might be $28, but you're paying $38 or $40 per coin. The official price is almost irrelevant. The market is telling you that the real cost of acquiring a government-minted ounce of silver is significantly higher. The same thing happens with 100-ounce bars. They typically carry a lower premium than coins, but when stress hits the system, that premium spikes too. This is the physical market voting with its wallet. This creates the hidden cost of cheap silver. An investor might see a dip to 26 on the futures exchange and think they're getting a bargain. But if the premium has expanded from 10% to 30% at the same time, the real price they pay has actually increased from $28.60 to $33.80. They celebrated a paper price drop but paid a higher total cost. This is how people waiting for a pullback get left behind. And here's the critical behavioral insight. Premiums rarely retreat to their old lows. Once the physical distribution chain adjusts to a new, higher cost basis and recognizes persistent scarcity, those higher premiums become the new floor. They might contract slightly during periods of low demand, but they almost never fully collapse. The market has a memory. It now prices in the persistent supply deficit and the rising industrial demand. So when you're setting that limit order, you're not just betting on the paper price dropping. You're also betting that the physical scarcity premium will magically disappear. That's a bet against the fundamental data. The premium is the truth serum of the silver market. And right now, it's telling a very different story from the one on your trading screen. So the question becomes, how can this divergence between paper and physical persist? Why doesn't the market just correct itself? The answer lies in the fundamental weaknesses of the market structure itself, specifically the delivery mechanisms of exchanges like the COMEX. The entire system is built on the assumption that someone, somewhere, will always have the metal to deliver. But that assumption is being tested like never before. The COMEX works on a futures contract system. When a contract expires, the holder can choose to take delivery of the actual metal. But here's the catch. The metal delivered isn't typically a handful of coins or small bars for retail investors. It's in large 1,000-ounce, good delivery bars. The entire process is designed for institutional players, not individuals. More importantly, the COMEX allows for something called cash settlement. If a holder demands delivery and the party on the other side of the trade can't or won't deliver the physical metal, the exchange can step in and settle the contract in cash. At the current paper price, this is the emergency release valve that keeps the system from breaking under pressure. It means that a physical shortage on the COMEX doesn't have to cause the paper price to skyrocket. It can just be settled with dollars. The paper market can continue its derivative game, pretending the physical metal is abundant, because the ultimate consequence of a shortage, a failed delivery, is circumvented with cash. This is where the concept of force majeure becomes critical. In the mining world, this is a clause in contracts that frees both parties from obligation if an extraordinary event occurs, like a mine collapse, a government expropriation, or a major labor strike. If a major mining company were to declare force majeure, it would mean they cannot meet their supply obligations. This would send a shockwave through the physical market, instantly validating the scarcity that the premiums have been signaling. The paper market would be forced to confront a reality it has been financially engineered to ignore. The ticking clock is on the registered warehouse, stocks on the COMEX. These are the inventories officially available for delivery against futures contracts. If those stocks fall to critically low levels, the credibility of the entire paper pricing system collapses. The market starts to question whether there's enough metal to back the billions of dollars in paper contracts. We've seen historical precedents for this, like the Hunt brothers' attempt to corner the silver market in 1980, which exposed the fragility of the system. The difference today is that the pressure isn't coming from a single speculator. It's coming from a fundamental structural supply deficit driven by industrial demand. The system's emergency release valves are being tested, and the clock is ticking. Now, let's talk about why this market structure failure creates such a dangerous trap for individual investors like you and me. It all comes down to psychology, specifically the limit order mentality. We're conditioned to believe that patience is rewarded, that buying the dip is the smart, disciplined approach. And in a normal liquid market, that's true. But in a market where the underlying asset is becoming physically scarce, that math changes completely. The behavioral economics behind this are powerful. We're loss averse. The pain of watching a purchase drop 5% in value immediately after we buy it feels much worse than the potential gain of a 5% rise. So we set a limit order below the market price to avoid that immediate pain. We tell ourselves we're being prudent, but this mentality ignores the asymmetric risk. What is the actual risk? The risk of waiting isn't just that the price goes up 5% and you pay more. The risk is that the physical market seizes up, premiums explode, and you can't get the metal at any price. You're trying to avoid a small paper loss while potentially exposing yourself to a total, permanent loss of opportunity. Let's look at the math of opportunity cost. Imagine silver is at $30. You set a limit order at $28, hoping for a pullback. You're focused on saving $2 per ounce. But while you wait, two things happen. First, the paper price grinds up to 30 tau. Your bargain. Price of $28 is now at 12.5% discount, which becomes statistically less likely. Second, and more importantly, the premium expands from 10% to 20%. So even if the paper price miraculously hit your $28 target, the real cost would be $33.60, 28 plus 20%. You were waiting for 28, but the real price you'd pay is higher than the 30 plus 10% it would have cost you to buy immediately. You lost the opportunity to acquire metal at a lower real cost because you were fixated on a fictional paper price. We see real-world examples of this all the time. Investors who waited for a pullback during the 2020-2021 bull run watched as silver ran from $18 to $30, and while it did eventually have corrections, the premiums on physical coins never returned to their previous lows. They missed the entire move, not because the price went up forever, but because the ground shifted beneath their feet. The goalposts moved. The cheap silver they were waiting for no longer existed in the physical market. The psychology of the limit order creates a dangerous inertia. It makes you a passive observer, waiting for the market to come to you. When the active players, the industrial users, the sovereign wealth funds, the large physical holders are actively taking the metal off the market. By the time your limit order gets hit, you might be buying the last few ounces available at any price. Or worse, you might find that the dealer's inventory simply says out of stock. The trap isn't just about price. It's about the illusion of control that a limit order provides in a market where the fundamental rules are changing. So what do you do instead? The strategy shifts from price speculation to physical acquisition. Focus on consistent accumulation, regardless of short-term paper moves. Dollar cost averaging becomes your best friend, not limit orders. Build a relationship with reputable dealers who prioritize inventory over price chasing. Consider diversifying your forms. Government coins, secondary market bars, even constitutional silver to maximize ounces acquired. The goal is to secure metal, not just a favorable entry on a chart. Physical possession, or verified allocated storage, is non-negotiable. The paper price is a distraction. The metal in your hand is the only thing that counts. The one thing to remember is this. The spot price is fiction until you hold the metal. Waiting for a pullback is a luxury this market may not afford. If this perspective shift was valuable, subscribe for more clear-eyed analysis on protecting your wealth with real assets.